Hi, everyone. Thank you so much for joining us today. I'm Marche, the webinar director here at Advice Chaser. Before we introduce our guests and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we are thrilled to bring you today's educational presentation. Attendees are muted, but we do encourage you to ask questions using the chat box, and the presenter will answer those queries during or after the presentation today as appropriate. If you ask a question in the chat box, go ahead and leave your contact information as well. If we can't get to your question during the event, we'll make sure someone reaches out to you afterwards to make sure that gets addressed. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. I'm going to go ahead and introduce our speaker now. Ethan T. Brown has a bachelor's degree in political science from the University of Michigan and an MBA from the University of Massachusetts at Lowell. He joined Cox Capital in 2015 and became a partner in 2020. His primary responsibilities include equity and fixed income research, portfolio management, and meeting with his clients. He holds the CFA and CFP designations. Ethan is a former national champion triathlete and an Olympic trials qualifier. In addition to his role at Cox Capital, he sits on the board of directors for the Drake Academy of Excellence. Ethan, we're so excited to have you here. Our attendees are in for a treat, I think. We've got a lot of great information to educate them on. So I'm going to go ahead and turn the time over to you.
All right, excellent. Well, thank you so much, Marche, and thank you to everybody for tuning in today. Now, this is my third time, I believe, doing a webinar with Advice Chaser, and I'm very excited to present this topic. I think it's very relevant for where we are right now. Are we in a recession? Are we heading for a recession? And again, just before I get started, I'll reiterate some of Marche's comments. Nothing I say should be construed as investment advice. Everything needs to be evaluated in the context of your personal situation. So if you'd like more information, please reach out to Advice Chaser or a financial advisor. So the way this presentation is organized, we start at the high level and are going to define what a recession is, what is the business cycle, how is that relevant for where we are. We'll draw some comparisons, but more so some differences between where we were in 2008, which was a really deep, devastating recession, and where we are today. In terms of where we are and where things may head, there are a host of economic indicators out there that we have a few examples and some charts in here that I'll show you and interpret for you, and it gives us some clues as to where things are headed. And finally, the third section I think is the most interesting. Will be, given what's going on in the world today, how should you be thinking about that from a personal wealth perspective? And you've seen the Fed raise interest rates. We have interest rates the highest they've been in about 15 years. The stock and bond markets have gotten killed this year. I'll talk a little about that, and talk about some strategies that have worked when investing in prior downturns. Yeah, so starting with the very basics here. So the concept of the business cycle is really this kind of repetitive cycle that the economy goes through, whereby things kind of go in these boom and bust type of cycles. So just walking you through, a generic example, if you're coming out of a trough or a recession, you're called what's in an expansionary period, and that's going to be characterized by a lot of things. You're probably going to see stock prices going up, the housing market going up, inflation is low, people are spending money, businesses are hiring. It's really the best time for an economy is when you're in an expansionary phase. And these are typically the times where returns in the markets are best as well. And then ultimately what happens is as the business cycle kind of gets long in the tooth, you may have the economy start to get overheated. And so at this point, the Federal Reserve will have to step in. Maybe this is because inflation is starting to go up a little bit faster than they would like. And by raising interest rates, it kind of puts on the brakes on the economy. And with many years of expansion, sometimes there's bubbles created in an economy, and that makes the Fed nervous as well. So ultimately what happens, you hit this peak point where things start to slow. And I believe that we're, in terms of where we are today, we're probably just past the peak. And this is kind of characterized by businesses slowing down on hiring. You may have markets get a lot more volatile. We've certainly seen that. Inflation is high, and that's causing the Fed to raise interest rates to try to fight that. That's certainly the period that we're in. And then if it's likely that we're heading for a contraction, and that would be characterized by people, consumers and businesses pulling back on spending, pulling back on hiring. People are going to save more as opposed to go on a vacation. And that kind of, it's psychological behavior to some degree, but it has a big effect in the real economy. And if enough people are nervous and enough businesses pull back on spending, it forces a recession basically. And so then we go back into that trough point until things wash out, until things hopefully improve, and then it starts kind of the next expansionary cycle. Just a couple of points about recessions. I mean, most businesses are started in recessions. If you look at like small business creation, people are laid off and they want to try something different. But they also are, if you take a very Darwinism view, they are healthy for an economy. Because if you think about it, if interest rates are low, if there's plenty of jobs out there, and the economy is booming, it's not that hard. It's a great environment for a business to operate, but things really get tough when you take away all those tailwinds. And so the businesses that can survive, even when you have, all these, adverse economic conditions, those are the ones that can really have staying power. So if you look at it like that, it does make businesses who can survive more resilient. But it's certainly destructive in a recession. You'll see unemployment go way up. And again, people pull back on spending. So those are the negative consequences, and typically it causes pain for everybody in those cases. All right, so what is a recession? There's a few different definitions. The most basic one would be 2 negative quarters of GDP. So GDP, gross domestic product, it basically describes economic output. So if you have economic output fall for 2 quarters in a row, that's technically a recession. And are we in a technical recession? Yes, because the first 2 quarters of the year have seen negative GDP. But there's another body, they're called the National Bureau of Economic Research, that this is the group that's like the official, deciders of whether or not we're in a recession, when the start date, when the end date is. It's a bunch of economists sitting in a room just talking about economic stuff. And so aside from negative GDP, you really need a couple other factors to have a true recession. And the big one is rising unemployment. You typically see the unemployment rate start to go up pretty significantly. And you look at where we are right now. I mean, unemployment, as of this morning, the new numbers came out, it's 3.5%. That's at a low, like in the context of history. So if we are going to go into a recession, which is, I think, probable, you're going to need to see that unemployment number come up. And so this National Bureau of Economic Research, they typically say that you need three things for there to be conditions ripe for a recession. You need what's called depth, diffusion, and duration. So by depth, you mean that economic conditions have to get really, really bad. By diffusion, you mean that it has to be spread through all parts of the economy. In duration, it has to last for at least a couple quarters or several months. So they state that, but then they kind of contradict themselves, because they're calling what happened in February of 2020 when COVID broke out, they're saying that's a recession, even though it was very, very quick. It didn't really hit that duration requirement. But it just goes to show it's technically they're the ones that decide, so they can basically say whether or not we're in a recession, but they're calling March of 2020 a recession. But where we are today, again, I think we're in a place that's likely headed for a recession, but we do not have a lot of the economic indicators that would say that you're going there are currently in place, because you've got high savings, again, low unemployment, consumers are still spending money. Businesses may be starting to pull back on hiring, but it's still a really healthy job market out there. So I hope that definition is helpful. And so from that technical perspective, yes, but from the true National Bureau of Economic Research perspective, we're certainly not in a recession yet. Yeah, when you look at really the differences between now and 2008, you realize what a unique period it was in 2008. I mean, there was so much speculation and risk taking going on by both banks and consumers, that it created the housing bubble, which was one of the largest bubbles in history. Now, you had a situation where all the incentives were misaligned. Banks weren't heavily regulated. You had appraisers, people that would go out and appraise properties. They were kind of in the bank's pocket. So if they didn't come back to the bank with a property value that the bank liked, the bank said, well, go find someplace else to work, basically. So that created this whole system of bad incentives where people were overvaluing property. Banks could lend money on that value, and they were lending to consumers that couldn't pay the mortgage, basically. So it really led to this awful crash that we had. It was a domino effect. It reverberated globally, and it was really one of the deepest recessions on record. Nowadays, you look at where the banks stand, where consumers stand. People are saving a lot more. Banks are heavily regulated. So there was this standard put in place after the financial crisis called Basel III, someplace in Switzerland, that really, they set capital ratios and essentially risk-taking standards on banks to make them a lot more conservative, and to make it so that if we did ever go into a real bad recession again, that they would have the capital reserves to basically weather the storm and not have to get bailed out by the taxpaying public. So we don't have those conditions where there's a massive bubble out there now. You have people with higher savings. The banks are taking on more risk. So if we do go into a recession, most economists predict that it's not going to be anywhere near as deep or as widespread as things were in 2008.
We did have a question here. How long does a recession last? Can you talk about the factors that go into that time frame?
Sure. Yeah, in general, you tend to have expansions last very, very long. I mean, we're coming off, we had an expansion from basically 2009 to 2020 that was over 10 years, one of the longest on record. Then we've had one again from the depths of COVID up until now. So expansions tend to be kind of long and gradual, where the recessions tend to come fairly quickly. So you're looking at like a matter of months or a matter of a couple quarters. So maybe things chug along for a few years, and then a lot of the recessionary factors come into play, and you start to see them in the economic data really, really bad for maybe 6 to 9 months, and then typically there's a recovery. So it can range. I mean, expansions range anywhere from 2 years to this most recent 10 years that we've had. Where recessions, I'd say now we're learning, that what would happen during February 2020 is considered a recession. So that was a month or two long. On the very extreme end, the 2008 financial crisis lasted a little over a year of about a year and a half of really recessionary conditions. So I wouldn't expect that to happen again, knock on wood, but I think a few months to a couple quarters is basically the kind of base case.
All right, thank you for that question. Let's
Sure.
move on.
Yeah, so we've got a couple charts here that illustrate some of the differences between like now and 2008. And when you look at debt to disposable income in the periods leading up to the financial crisis back in 2007, I mean, that number, it was over 130, 140% of disposable income is what folks typically had in debt. And so it really took that debt cycle a long time to kind of work itself out of the system. And now you look at where we are today, we're at 100% debt to disposable income. That's much closer to kind of the historical norm. And again, it's 30% lower than we were in 2008. So this is just one data point that illustrates the sharp contrast in the level of debt between then and now. And then similarly, we've got personal savings as a percentage of household debt. And so this is typically averaged a little over 5%. And that's where we are today. This personal savings as a percentage of debt is 5%. The conditions leading up to the financial crisis in 2005, I mean, it hit a low where it was below 2.5%. And it's such an extreme point because people, they took on a lot of debt and they saved less. That's just like a bad combination to have. And you can see that in 2008, when the crisis did hit, the savings rate goes up. People start to save a lot more because they're so nervous about what's to come. They'd rather not go on that vacation. They'd rather keep that, $2,000 in the bank and be able to sleep well at night. So it took a long time for people to gain confidence and to start to spend again after 2008, which was why that following expansion was so kind of long and gradual. What's interesting on this chart too is during COVID, you had people stuck at home. You had government sending out stimulus checks. So the savings to household debt went to like a all-time record. Because people, they got all this liquidity and all this new money and they couldn't go anywhere and spend it. So it was a really interesting time, but that's come back down to normal levels. And so this is just something else we look at to determine the health of households around the country. And so far, it's not really flashing any warning signs.
We did have a good question that came in. I wanted to address it before we got too far. This is a question about the recovery from 2009 to 2020. Was a long but very slow growth. How does this compare with other historical cycles?
Yeah, the cycle from 2009 to 2020, it was a lot more gradual than previous recoveries. Previous recoveries tended to be a lot more sharp. Consumers gained confidence a lot quicker and came back and started spending, and businesses started hiring quicker. It really was a deep scar that was created in 2009. So even though the government, so it was interesting because the government had given out more stimulus than ever before in history, but the recovery was a lot slower and longer than anyone in history. So it was a bit of an outlier when you look at like the full set of economic recoveries going back to early 1900s. And yeah, we just, even on the housing front, I mean, we're still not building the amount of houses annually that we were in 2007. Like we're not back to that point yet, back during the housing crisis. So, it was such a big bubble, and I think that created just so many scars that made it a long, gradual slog of a recovery, very, very modest by historical standards. Yeah, and so where does the pandemic come into all this? I mean, this was really interesting. We talked a lot about this on the inflation webinar, a month or two ago. But essentially what happened during COVID was, people were stuck at home so that you couldn't spend money on services. The government sent out all these stimulus checks, so people had a ton of money, no place to spend it, and they're stuck at home. So what did they do? They started to buy more stuff off Amazon. Think everybody did that. The Peloton stock went crazy because everyone's buying a Peloton now. Apple was selling more iPads, iPhones, and doing more service business as well. So all of a sudden, there's this wave of demand for hard goods came at a time when the world is shutting down due to COVID. And it put tremendous pressure on supply chains because you had, borders were closed, so you couldn't get into other countries. China has their zero COVID policy, so they were locking down manufacturing facilities. And what happens when you have a wave of money trying to purchase goods and there's not enough goods, the price has to go up. These companies realize that they've got no inventory and people want what they have, so they need to raise prices. And so we're still kind of feeling that effect. That brought on this wave of inflation. And it's still not back to normal today. We still have supply chain pressure is easing a little bit in the data, but it still has a long way to go. And then you throw in some of these other geopolitical events, the war in Ukraine. Ukraine was one of the biggest producers of wheat in the world, which is an input for a ton of foods. So that's still in disarray. We all know what's going on in Europe with the energy crisis. Russia was a big supplier of their natural gas, and that's had all sorts of problems. And certainly when you're fighting a war, it's tough to focus on supply chain efficiency. So the pandemic really was a catalyst to kind of expose all these cracks in the economic foundation. And as an aside to this, what businesses realized was you've spent the past 30 years outsourcing your production to other countries. And then when you really needed inventory, you couldn't get it. So what's happening now is a lot of these businesses are trying to duplicate their supply chains and build, plants and hire workers domestically so that they never have to be in the position again of running out of inventory at a time when they need it most. And that's inflationary as well, because if they want to build new plants and hire more workers when we have a shortage of materials, a shortage of workers, prices are going to go up. So that's what the world is dealing with right now. That's why the Fed is raising interest rates. And that rise in interest rates, the rapid rise in interest rates, is what's really putting a damper on growth in the country right now. So when we look at the economic data out there, there's a really good indicator that I look at every month. It's put out by an economic group called the Conference Board that has a fairly good track record of predicting recessions. So they call it their index of leading indicators. And what it is, it's 10 different data points that are comprised of little pieces of economic data that should be forward-looking and predict economic activity like 3 to 6 months down the road. So an example on here is housing starts. So if you are, a real estate developer and you go to the municipal office to apply for a new housing start, it's likely because you're going to build a house. If you're going to build a house, you're going to be hiring workers. You're going to be buying raw materials. Those workers are going to come to the job site. They're going to spend money at at local restaurants and stores and things like that. So that's a fairly reliable indicator that if you're going to apply for a housing start, you should see this economic activity down the road. So we've started to see a lot of these things drop off a little bit. Housing starts are down. It's harder to find workers. Prices have gone through the roof, so it's harder to build for a lower cost. So that's starting to roll over a little bit, and so that's kind of dragging down the leading indicators. Consumer confidence is another one that goes into this leading index. And essentially, when people are nervous and scared about the economy, like I said before, they're going to be more likely to save money, not spend it. So that's another one that's starting to kind of roll over as well. And when you look at where things are, I think we have some charts later, but people are really, really nervous out there. I mean, we haven't seen inflation in 30, 40 years like we're seeing it today. And so people are scared about that, and they're starting to reconsider their spending plans. Jobs are starting to rethink their hiring plans. So you really do have the conditions ripe for a period of some economic pain ahead, unfortunately. And we can go to the chart now, and we'll see where things stand today. So just when we look at this, these red bands on the chart here, so these represent recessionary periods in the past. And so these leading indicators, you're looking at it on a stacked kind of year-over-year basis. You see back in 2007, there was a pretty fair warning that we were headed for something bad, because you had a period where these indicators went negative for about a year before things started to get really, really bad. When you fast forward to where we are today, we're coming off a period of extremely strong growth from COVID. We had all this stimulus. You had people wanted to get out, travel, go back out to their favorite restaurants and spend money again. And that was all well and good until inflation really started to put a damper on that. And what's interesting about what's happening right now is just the rapid pace at which these indicators are falling on a month-over-month basis. So this really corresponds to when about 6 months ago, when the Fed started raising interest rates more aggressively. So we were really chugging along. We kind of start to go down and down. And I would think this is going to continue. Typically, monetary policy, like raising rates, it takes a minimum of 6 months before those increases are really felt in the economy. So just now, we're starting to see some of the effects of those rate increases. But what the Fed really wants to do is really kill demand and have unemployment rise a little bit. And we're not quite there yet. But just looking at the pace of these indicators, it's likely they will continue to go even more sharply negative. And historically, that is predictive of a recession. So I think most economists are thinking in the next year or so, we're likely to see some sort of recession.
I did have a question here about the presentation. We will be emailing our attendees a link to the replay of this event. So if you're not able to take notes right now, or if you want to refer back to this later, you will have access to this, and we will also post it on our website at advicechaser.com. All right, let's dive into this one. I know you've talked a little bit about this consumer expectations index already.
Yep. Mm-hmm. Yeah, so the University of Michigan puts out these consumer sentiment surveys every month, and they have data going back decades and decades. So their consumer expectations index is just asking people how they feel about the next few months going forward. And what's notable about the data here is that you really have things have dropped off to the levels they were like back in 2008, 2009, in that really, really crisis type period. And as weird as this sounds, that's probably a bit of a good thing, because if people are this nervous about the future, there's less likely to be like any excesses, any housing market or stock market bubbles. And you look at what's going on in the stock market this year, we're officially in a bear market where stocks are down more than 20%. I think that's what the market's discounting is bad times ahead. So I think a lot of this bad news we have out there is already priced into the markets. And it's also, in a weird way, there's more likely to be like upside surprises when sentiment's so low, and then there's more likely to be bad surprises when sentiment is so high. So in a contrarian way, it's good that people are nervous about things because it reduces the chance of any excesses in the economy. And I think good news could surprise to the upside given how bad people expect things to be. All right, this is another closely watched indicator by the Federal Reserve. This is new claims for unemployment. And so when you look on the chart here, you can see that the recessionary periods on this chart are kind of characterized by this new claim and unemployment number going up quite a bit. So this comes out every Thursday, and it's basically how many people filed a claim for unemployment. The Fed has said that as long as less than 300,000 people per week are filing for unemployment, then that should still be an expansionary environment for job creation. And so you look at where we are today, and this is probably as of a few weeks ago, September 27th, it's still at 213,000. So we're still well below that 300,000 benchmark. And there isn't really a clear trend that it's rising steeply like we did see in previous recessions. What happened in 2020 with COVID, I mean, you almost can just take that little period out because it was such an extreme example where people, they were forced to stay at home. So you had so many people going on unemployment. No, but we've really recovered from that. We're back to a booming job market. And although maybe it's slowed a little bit this morning, that the numbers were pretty good for the unemployment report. The conditions really aren't setting in that would say, we're going to be in a recession next month because the job market's still just so strong. And we're not seeing the rise in claims that you think we should see. But again, I'll say that the Fed rate hikes, it takes 6 to 12 months to really reverberate through the economy. So we're just getting to the point where we might start to be feeling those effects. So this is going to be a really closely watched data point in the weeks to come. So this is manufacturing new orders. This is another leading indicator. And again, it's just like the housing starts. If manufacturing companies are getting new orders, then they're going to be paying more staff. They're going to be buying more raw materials, and it's going to create economic activity. So you see where this stands today. I mean, it's pretty close to its all-time high. It's pulled back maybe a tiny bit. I don't know if that's the start of a new trend or if it's kind of just a blip on the radar here. But this would suggest that things are still pretty good in the economy. And so the Fed, by raising rates, they're trying to dent some of these numbers. I mean, they want unemployment claims to go up. They want manufacturing new orders to go down because that's going to show them that by raising rates, they are taking steam out of the economy, and that should take some pressure off inflation, which is their whole goal. But so far, I mean, this would say things are still pretty good in the manufacturing sector. And so in terms of, what do the smart economists think about what's going to happen? I hear a lot of economists speak. I think most have the base case that we're going to hit a recession sometime in 2023, maybe 2024. Nobody really knows. I mean, even economists admit that they're terrible at making predictions, so that they're good at interpreting data, but they don't always know when things are going to come. So one perspective, if you're kind of an opportunist, if you've been waiting to buy a house, or if you've got a lot of cash on the sidelines, recessions, they are a bit of an opportunity. I mean, you look at stock market this year down over 20%. Historically, when you're investing at these kind of troughs, the returns are really good going forward. That's not a recommendation. That's just looking at the historical data set. Similarly, if you were waiting to buy a home and you didn't want to get caught in a 10-way bidding war, well, that's likely to kind of pull back now that things are slowing down. Housing prices are coming down a bit. So from that perspective, it is an opportunity. One of the staples in financial planning is make sure you have an emergency fund. I mean, most planners out there will tell you, if you're in a dual income household, you want to have about 3 to 6 months worth of living expenses on hand just for an emergency. If you're in a single income household, maybe it's 6 to 12 months. So that from a financial planning perspective, I mean, you want to just have a little extra cash in case something goes wrong. And one recommendation not on here is just be nice to your boss. Maybe if you're going to go to Starbucks, get him or her an extra coffee, because you don't want to be the person on the chopping block these days. Yeah, so given everything that's going on in the world, how can you maybe take advantage of it, or what can you expect from like a personal wealth perspective? This I'm really interested in this. This is what I do on a day-to-day. So the past 10, 15 years have really been awful if you're a saver, because interest rates have been zero. Well, that's not the case anymore. The Fed has embarked on their most ambitious tightening cycle since the 1990s. Interest rates have shot up. I pulled these rates a few weeks ago that are on the screen here, and they're even higher since. But I mean, you look at a 1-year treasury bond right now is yielding over 4%. So if you're a saver, you're going to start to be able to get a higher interest rate in all the cash you have in the bank. Now, that said, I was at a banking conference a few weeks ago, and I met with probably 12 or 15 different bank management teams. Nobody's in a hurry to raise their deposit rates. I mean, banks love this environment because a mortgage now costs 7% interest rate basically, and their deposits only cost 1-2%. So there's always a lag between where the Fed raises interest rates to, and then where the bank is. I mean, theoretically, the bank should be raising it pretty quickly to keep in line with where the Fed funds rate is, but that's not happening because there's really not a whole lot of competitive pressures just yet on the banks. I mean, they're looking at each other saying, well, if the bank across the street isn't raising their rate, I'm not going to raise ours. It means the banks will be more profitable. So if you have access to, investing in short-term treasuries, you have extra cash. I mean, that's really the best game in town right now in terms of kind of risk-free type of short-term securities. So we haven't seen it again in 15 years. It's likely to continue to go up. And, if you've got a lot of cash on the sidelines, again, I would be shopping around. And a lot of banks, if you've got a lot of cash with them, if you call them up and threaten to pull your deposits, a lot of times they'll give you a special rate as well. So that's something to keep in your back pocket there. And so with historical recessions, you tend to have this phenomenon where, I guess it's pretty self-explanatory, but defensive stocks tend to do better. So when you think about just in broad categories, defensive versus cyclical, defensive are areas like utilities, healthcare, consumer staples, groceries, things like that, where they're not going to see their demand fall off if we're in a recession. Because you're still going to turn on your electricity. You're still going to go to the doctor if you get sick. You still need to buy groceries. So theoretically, it should not be too affected by kind of the ebbs and flows of the economy. That's not true on the cyclical side. I mean, maybe you're not going to take a vacation. You're not going to buy that new car. You're going to make your iPhone last another year until the next upgrade cycle. Those sorts of things are purchases that are cyclical. They can be delayed. And so those companies that operate in the cyclical sectors tend to not, not do as well during recessionary periods. Finally, one of the real, I'll call it the disappointments of the year, has been traditional diversification between stocks and bonds has not worked. Stocks are down 20%, bonds are down about 15%. Historically, you'd think that they have an offsetting effect against each other. That hasn't happened this year. I don't think that'll continue. And I'll talk about why in a second. We have kind of charts for each of these points. So why don't we move forward, and I'll get into that in a second. So first, on the defensive stock front, excuse me, what you're looking at here is two different indexes. You have the S&P 500, then you have what's called the S&P Low Volatility Index. And so this low volatility index it's a subset of the S&P 500, but it's invested in the least risky companies in the S&P according to their methodology. And you look at how they've performed through the end of September, and it's really what you would expect. I mean, the lower volatility or lower risk index is down about 13% versus 23% for the S&P. And so when you kind of peel back things further and kind of look at the composition of both of these indexes, it becomes really apparent why this low volatility index has done well. So you look at the top names in here. You've got Johnson & Johnson, Pepsi, Gilead Sciences, Duke Energy, a lot of utilities, Staples, healthcare. This is just what I was describing about how when things get bad, their demand should not be as affected. You look at just the standard S&P 500 index, Apple, Microsoft, Amazon, Tesla. Those are companies that are likely going to see their earnings have some cyclicality if we do go into a recession. Like I said, you're not going to upgrade your iPhone on this cycle. If you're thinking about getting a new car, Tesla might be a little out of your price range if you're trying to do that in a recession. And again, with Amazon, I think everybody could cut their Amazon bill if we made a little effort. And so you don't have to do this stuff until things get bad. And so that's why you've seen this kind of more defensive index outperform. And this is very traditional during recessionary periods, that you do see defensive stocks do better. It's one of my personal philosophies. I really like kind of investing in more defensive areas because I don't really like all the volatility of some of the more cyclical companies. But so then this is just something to kind of keep in mind when you're thinking about what sectors do well in recessions. It's really the defensive ones for good reason. And then this is my point here on stock and bond correlation. So if you look at this simple chart, we have like the ideal example, what you want. Stocks are down 10%, for example. Well, bonds are up 8%. Maybe this is a hypothetical example. You generally want that behavior. You want to build a portfolio where when something goes down, there's something going up to kind of offset that. That's what diversification is. And what's gone on this year is it's been big destruction in both bonds and stocks. And so what's going on in the bond or fixed income world is directly correlated to the Fed raising rates. I mean, as rates go higher, bond prices go down. And so that's why we're sitting here, and it's really been, I think, the worst year for bonds on record, almost in history. It's really incredible what's happened, and what's supposed to be a safe kind of low volatility asset class. It's really they've had just as much volatility as equities in some cases. So I don't think that is going to hold true going forward. And the reason is that eventually the Fed is going to stop raising interest rates once inflation gets under control, once they see the economy start to slow. And so that should be pretty good for bonds. And when you look at real long-term interest rates, they tend to be very correlated to the economic growth of a specific country. So in the US, we're really a mature economy. We have relatively slow economic growth relative to emerging markets. And we have a big demographic headwind of more people are retiring. We have an aging population, and we don't have an immigration plan that's kind of filling all the job openings that we need. And so that's really going to provide, in my opinion, a cap on long-term interest rates. So I do think that, if things get really bad, we go into a recession, and it's a bad enough recession, the Fed is going to have to drastically cut rates, and that would cause bond prices to go up. So I think most of the pain that's been in the bond market is probably in. Right now, if you look in the futures market, they're predicting the Fed is going to raise rates till about early 2023, at which point they can kind of hold it steady for a little bit. So I believe a majority of the pain that's been experienced in the bond market is already in here. And if we do go into a bad recession sometime in the next year or so, I think that bonds will kind of have their traditional hedging characteristic where they have positive returns when stocks may not do so well. So I don't like to speculate, but just looking at where things are today, how things have played out in the past, I think that's a likely assumption of what may happen.
All right. Well, this has been a lot of data. I do have some questions here, and we'll go ahead and take these questions and then wrap things up. This is a good question. Why are weaker jobs numbers better off for the economy right now?
So it's really interesting. We're almost in a paradox of a situation where weaker jobs numbers, would be bad for the economy, but they would be good for markets. And the reason is if we got bad jobs numbers, it would show the Federal Reserve, that their interest rate increases are working, and that they may not have to be more aggressive. And when you look at what's gone on in markets this year, that the poor performance in stocks and bonds have been directly correlated with the Fed aggressively raising rates. So presumably, if they don't have to raise rates as fast, or they can back off a little bit, it would be good for markets. And the reason that the Fed thinks it would be good would be as if unemployment's going up, there's more people filing for unemployment, then people aren't going to be spending as much, and that's going to take the pressure off inflation, which is their main goal. So it's a little bit backwards now, because it's like bad news is bad news for the economy, but good news for markets. So it's an interesting time.
All right, here's another question. And then I think it's referring to that consumer expectation survey or indicator that you showed. So what effect does consumer attitude have in driving a recession?
A big one, definitely a big one. And one of the other things to look at from the perspective of the Fed and think that what they're doing is working is consumer expectations have gotten so low. And so you can almost talk yourself into a recession, because if enough people are nervous about the future and are not spending, and that causes small business owners to not hire new workers and maybe lay off people preemptively, not because things are bad, but because the expectation that things will be bad, that could absolutely cause a recession. And so it's certainly a risk, but the Fed has been extremely explicit with their resolve that their mandate is to get inflation down. Even if that puts us in a recession, they are willing to do that. So it's tough because the consumer sentiment numbers are not good. But we still have high inflation right now, and people are uncertain about the Fed's path, but they don't seem to be letting up anytime soon.
All right, we'll take one more question here. Let me go ahead and get that up. Has the Fed indicated at what level inflation will be acceptable so that they're laying off raising interest rates?
They haven't specified a certain level, but what they're looking to see is a successive decline in inflation. And so the Fed does not look at the CPI number, Consumer Price Index, which is kind of the most widely followed number. They look at this other metric called PCE, it's personal consumption expenditures, as a way to measure inflation. And so I don't think there's a number they're looking for, but if they see several months of successive declines, that's the trend that they want to see. And I think that would probably give them, some confidence to back off. And they're looking at everything. I mean, they say they're very data dependent, and so they're not just looking at that headline inflation number. They're out talking to businesses. They're looking at the unemployment data, manufacturing and services data. There's a host of economic data that's released every week, and they're kind of combing through it, looking for clues as to where inflation's headed. But again, I think they're really looking for the trend as opposed to a specific number.
All right. Well, thank you everyone for your questions. If we weren't able to get to your question, go ahead and leave your contact information in the chat, and we're happy to reach out to you after today's event. I want to thank Ethan for being here and for such an informative webinar. We want to thank the organizations that have worked with us to bring you this webinar today. Thank you so much for attending. Look for an email soon with a link to the replay of this event, and you're welcome to share that replay with your friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we'll see you at another webinar soon. Goodbye,
Thanks,
everyone.
Bye-bye.